Please welcome to the show, Mr. Dan Geltrude. Dan, I can hear my dad say it now, gold and Bitcoin going up like a homesick angel. What are your thoughts?
Well, listen, Scott, when you have a balanced portfolio, gold and Bitcoin should both be part of it. I mean, that's all about balancing risk. So let's go to what we're seeing right now related to risk, because gold and Bitcoin are signaling the same thing. It's flashing out there, and that's Americans are losing faith in Washington and the Fed. So, you need to be really careful about what's going on here. Listen, gold and Bitcoin don't care who the president is, right? What they care about is debt, inflation, and dysfunction. And right now we have plenty of all three. And that's what I think we're seeing in terms of the reaction of investors with gold and Bitcoin.
I think we should take a little bit of notice about what's been happening in France. I don't know if you've seen it, but again, the prime minister resigned. They've had 5, I think, in 2 years. And really it comes down to this. And I think that we really should take notice because they're in a position that we could be getting in ourselves. They got no more money left, right? And the government's trying to put in some austerity measures, and the electorate, they're just not having it. So they keep marching in the streets saying we have to have more money, we need this, we need that. But at the same time, the cupboards are bare. That is something that, and you can see what happened to their market, their stock market today. That is something I think that unfortunately, slowly but surely, we're marching towards here. What say you?
Oh, I agree with that. Absolutely. Nobody wants to feel any pain. And certainly politicians don't like to feel any pain because that always jeopardizes elections or re-elections. So give the people what they want in spite of what the consequences can be down the road, especially because politicians and people in government look at that and say, oh, by the time it hits the fan, we'll be out of here. It's someone else's problem. But it is a real concern, Scott, and that goes to the level of national debt because we just keep printing and printing like the good times are never going to end. And I don't know when they will end, Scott, and I don't know how much debt we could hold until literally the dam breaks, but we just know at some point it will. And then austerity, well, there'll be no choice, right? You turn out to be like Greece.
Well, I also think it's important when it comes to austerity measures, and we may come to that point here in this country. The earlier that you do them, you can do them on your own terms rather than have the market dictate. Because when Mr. Market dictates your austerity, it tends to hurt a lot more. Now, there is a chance that this government's turned its back on inflation and they're going to worry about jobs, or at least the Fed is, in the short term. But is there anything to them maybe letting inflation run? Because at some point in time, the only way it looks like we're going to get out of our debt because we don't have anybody in Congress that's willing to stop spending. But is it something that we might have to start inflating our way out of?
Well, that's the $37 trillion question here, Scott. I mean, right. It just doesn't seem to me that anybody has the political will at any level. And if you look at what's happening with the Fed, I mean, right now, investors are betting that Jerome Powell is going to cave again on rate cuts, And I think that that's probably going to be the case. So we're going to see, rates coming down. Now, is that going to fuel some level of inflation? It might. Look, Scott, there's a lot of things that are firing off right here. Look at the jobs numbers, but we don't have them. But surmising what we think the jobs numbers are, I think it's clear that at best, we're stagnant. And I think that employers right now are just holding on to who they have, and they're certainly not hiring more people. Now, whether that's going to turn to unemployment numbers, well, that remains to be seen. And there's a lot of factors at play there, Scott.
Do you think that the Fed just needs to come clean and tell us they're going to be happy with 3, maybe even higher than that inflation?
No, I don't think they're going to do that, Scott. I think they're going to still turn around and say, we want that 2% number and they're going to stick with it. I don't think we're going to get there because I think there's enormous pressure right now to lower rates. And when you lower rates, we're not going to see that inflation number come down. I believe what you said is true, that we'll probably have to settle for 3.5. But I don't necessarily think that the Fed is going to turn around and ever acknowledge that.
Well, I mean, if they did turn around and say 3% is the new rate, I think the stock market then would run even higher. Unfortunately, that's going to make more people worried. But we have one thing I'm going to leave you with. This is going to be my theme for the day, Dan, is, all-time record highs in the stock market, a GDP number that knocked it out of the park last time. We've got great corporate earnings, a 4.3% unemployment rate, and we're cutting interest rates.
Right.
That sounds a little weird. Sounds weird to me.
Yeah, it does, because how much are you looking to really juice the economy looking at where those numbers are? And look, Scott, I think the big variable in all this is where AI is going to take us over the next few years. Because if AI is going to equate to less jobs, more corporate profits, well, I think a lot of things are going to get turned upside down in terms of the gap between the haves and the have-nots.
I think that's exactly what's going to happen, Dan. Unfortunately, I think that's exactly where we're headed, and I think you nailed it right on the head like you always do. I appreciate you coming on, Dan. Dan Geltrude coming to us from Nutley, New Jersey. Thanks for opening up our week here. I love having you on. We'll see you again next Monday. All right, now here's